Welcome to another deep dive into the world of finance. Today, we'll unravel the concept of loan covenants, an integral part of borrowing and lending that can influence the financial health of both parties involved. Let's start with the basics. What exactly is a loan covenant? In simple terms, a loan covenant is a clause in a loan agreement that requires the borrower to fulfill certain conditions or prevents the borrower from undertaking certain actions. There are two primary types of loan covenants: affirmative and negative. Affirmative covenants require the borrower to perform specific actions, while negative covenants restrict the borrower from certain activities. An example of an affirmative covenant could be maintaining a minimum level of insurance coverage. On the other hand, a negative covenant might prohibit additional borrowing beyond a certain limit. Imagine a company, ABC Manufacturing, that takes a loan of $1 million from XYZ Bank. An affirmative covenant might require ABC to maintain at least $100,000 in cash reserves. A negative covenant could restrict ABC from issuing dividends if their debt-to-equity ratio exceeds a certain threshold. Breaking loan covenants can lead to severe consequences for the borrower. One common repercussion is that the loan can be called, meaning the lender can demand immediate repayment. Other penalties might include increased interest rates or additional fees. Now, let's visualize this with some data. Here's a bar chart showing the number of loan covenant breaches across various industries in 2022. As seen in the graph, the technology industry had the highest number of breaches, followed by the energy and healthcare sectors. Understanding industry trends can help lenders anticipate risks and set appropriate covenants. Questions to consider when evaluating loan covenants include: 1. What are the financial conditions of the borrowing entity? 2. What is the purpose of the loan? 3. What are the current market conditions? Careful evaluation of these questions can help both lenders and borrowers mitigate risks. Consider another example with data. Suppose you're evaluating the financial health of a company. Here's a line graph representing the company's EBITDA, earnings before interest, taxes, depreciation, and amortization over the past 5 years. By analyzing the EBITDA trend, we can see that the company experienced growth until 2020 but faced a decline in 2021 and 2022. Such trends are critical in setting realistic and enforceable covenants. To further elaborate, let's answer a few commonly asked questions. Q1. Why are covenants important for lenders? 1. Covenants help protect lenders by ensuring that borrowers maintain certain financial health standards. This reduces the risk of default. Q2. Can loan covenants be renegotiated? 2. Yes. Borrowers and lenders can renegotiate covenants if circumstances change, though it may involve additional costs and amended terms. Let's now consider an important metric often included in covenants: the debt-to-equity ratio. This ratio is a measure of the financial leverage of a company. It is calculated as debt-to-equity ratio equals total liabilities / shareholders' equity. For instance, if ABC Manufacturing has total liabilities of $800,000 and shareholders' equity of $1,200,000, the debt-to-equity ratio would be debt-to-equity ratio equals 800,000 / 1,200,000 is equal to 0.67. This indicates that for every dollar of equity, the company has 67 cents of debt. Visualizing debt-to-equity ratios across different sectors can provide valuable insights. Here's a pie chart showcasing the average debt-to-equity ratios for sectors like technology, healthcare, and manufacturing. The pie chart reveals that the technology sector has the highest average debt-to-equity ratio, implying that technology companies typically have higher financial leverage compared to healthcare and manufacturing sectors. Regularly monitoring compliance with loan covenants helps in early detection of potential financial distress. This proactive approach allows for timely interventions and renegotiations, thereby maintaining financial stability. In conclusion, loan covenants serve as critical financial safeguards, ensuring that borrowers maintain certain standards of financial health and operational conduct. Both lenders and borrowers must understand and negotiate these covenants effectively to secure mutually beneficial financial agreements. Thanks for watching. Be sure to subscribe and hit the bell icon for more insights into the world of finance. If you have any questions or topics you want us to cover, drop them in the comments below.